So in order to understand, the market, we know it's based on supply and demand. And we also know that institutions drive the market. And we want to talk a little bit about what's happening in the dominance of institutions. So institutions, when we think about a stock, there's a certain amount of float, the number of shares that are available for trading. And if I look at that as a pie, say here's a nice apple pie, and we say, well, here's all the shares that are available. And you say there's really three categories of where the shares go. One, we have long-term holders that are going to park their money for 5 to 10 years. These really are pension funds, banks, very passive ETFs. And they take up a huge chunk of the float. Once they buy, Apple or one of these big liquid names, they park their money looking to say it's providing a dividend or it's got slow growth, but it's safe growth. Big piece of the pie. Then we have number two, which is really active institutions. And these are your active mutual funds, whether they're growth funds or value funds, hedge funds. They're very active, they're shorting, they're long, etc. That's another significant chunk of the pie. And institutions do extensive research on companies. And, institutions are not using technical analysis like retail traders. They're using valuations. They're looking at spreadsheets, they're looking at cash flow, they're looking at discounted cash flow, revenue projections, product development, R&D, et cetera, et cetera. Lots of spreadsheets. And that's what they're doing. And they're trying to say, if we buy a stock today in a big position, where will it be 2, 3, 4 years ahead? They're not looking to flip it in a quarter. They want to hold it for a number of years, but they're using extensive research. And then we have the retail traders, like you and I, retail investors and traders. These are your day swing and position traders. And we generally use technical analysis and breakouts and oscillators, etc. We're another piece of the pie, but it's a small piece of the pie. Probably no more than 15% of the trading in a day. A good 85% is done by institutions. So supply and demand is, we're looking at buy orders and sell orders, and where on the scale is the scale being tipped to supply, or is the scale being tipped to demand? When these shares get the float starts to get chewed up, when funds are accumulating shares, they're putting them away for potentially 2, 3, 4 years, and they're no longer traded in that fund because they're actually building a position they want to hold. So they keep absorbing more of the pie. And so once the passive investors have put shares away in the lockbox, and these active growth investors have started to establish positions, there's only a little bit of float sometimes left. And that really becomes the crumbs for either retail investors or other mutual funds that really, really want the stock, and they have to pay up. And that demand equation is what drives the price higher. So, like I said, institutions take their time. They're looking at valuations. It takes time for them to build their big positions. They want to grab shares at the best prices possible to hopefully improve their fund's performance. These big institutions will generally use technical analysis to fool retail traders by creating shakeouts, creating false breakouts, and try to basically grab your shares. So let's just look at this from a perspective of an example of one mutual fund. Let's assume you're a growth fund and you have a $2 billion assets under management, and your fund has done its research and you want a 1% position in a stock. So if you want a 1% position, that's going to be about a $20 million investment for the fund. So how does that work out? Let's assume in this example, it's a $50 stock. That means the fund has to accumulate 400,000 shares of that stock to get their position. Now, let's assume that the stock trades 1 million shares a day. It has some liquidity. So there's 1 million shares that are trading. But the rule of thumb is, generally speaking, you don't want to be buying more than 1% of the trading volume per day, because you could really start to move the stock. So if we use that as a guide, that this institution says, we can't buy more than 1% of the volume every single day, so we got to do this in a very controlled way. So you'd have your 400 shares that you want to accumulate, but you're really limited to buy about maybe 10,000 shares a day. And if you did that consistently, it would take you 40 days actually to build that position. Now, they're not going to buy every single day because they're going to keep pushing the price higher and higher and higher. And this institution, they want to buy the shares at the best price, the lowest price possible. So they're not going to buy consecutively for 40 days. So let's assume that they're buying their 10,000 shares, but they're doing it every other day in this example, because they're going to let the stock pull back. They might not buy for 2 or 3 or 4 days, but let's assume that on average, every 2 days, they get their 10,000 shares. So that tells you that it would take 80 days of trading for them to get their position, which is 16 weeks. So that's 4 months. So it takes quite a long period of time for an institution to build a $20 million position. Now, don't forget, this is only one mutual fund. If you're in a stock like NVIDIA or one of these big liquid leaders, what if there are 50 to 100 or more funds that want this type of position? Well, you can see how that starts to build demand. And it takes time. That's why model book stocks take, they take 12 months to 24 months. There's a big period of accumulation. So that's how institutions do it. And it takes time for them to build their positions. What's important, though, is once they have their position on pullbacks, they will support the stock. So they won't break the stock down until it gets late in the move. And then they will start to liquidate their position. So these elephants are something that we follow. We want to follow them and hop on their backs essentially because they're the ones creating the buying demand.